Welcome everybody to our next video. Holy smokes, do I have a lot of news to go over today. What's happening with the banks, these new banks that are on my radar that are in big trouble. But we also have some other big news, what's happening in China. You're not going to believe what they just did today. We're going to quickly recap what happened in the markets today and what's going to be happening in the markets going forward, because this week has been an absolute wild week. And I don't know if you noticed a theme, but I remember last year it was a very bad month for the stock market and for the financial markets in October. And October has a very dark history for the market. So could the October curse be about to repeat? Well, that's exactly what we're going to cover in today's video. Again, all these new banks that are facing big issues and why exactly they're facing big issues. So you know what time it is, ladies and gentlemen. Let's get straight into the news, the facts, and the data. So look at this, everyone. Before I get into those four banks that are facing big issues, we need to talk about this. Look at this. China injects most short-term cash into the banking system on record. That's right, people. They're breaking records and not the good records. So I can't overstate this enough. We're in big trouble. The banking system globally, not just in the US, this is happening in Australia, this is happening in Europe as well, okay? There's going to be huge amounts of banking stress in the banking system globally, which could lead to a financial crisis. So what exactly did China do? Well, it says here, the People's Bank of China granted lenders a net 733 billion yuan, that's $100 billion US of cash, with its so-called reverse repurchase contracts on Friday. So that's right, $100 billion in just one day. This is not happening over a year, okay? It's happening in one day. And again, this is why you can't trust the data coming out of China. You need to follow the money. So that came only a few days after the central bank made the largest injection of one-year policy loans on Monday. So we got the GDP data out recently from China. They said, look, China's not in a recession, but its economy is still growing. I don't believe that at all. Country Garden defaulted on their bond. They're even bigger than Evergrande. Evergrande officially has collapsed. Country Garden is now officially collapsed. They officially have not paid the interest payments due on the dollar-denominated bonds. Their housing market is imploding, but we can't get the truth out of the data. So we can't get the truth from China, so you need to follow the money. So unlike they're saying their economy is imploding. So the injection of extra cash into the economy will offer a much-needed boost to China's growth, which has been challenged by a lack of demand and downturn in the property market this year. Because again, the property sector makes up 30% of their GDP and 70% of China's wealth, or should I say the average citizen's wealth. It will also provide lenders with sufficient funding as Beijing and local governments are set to sell more bonds to finance stimulus spending and as tax payment season approaches. So that's what's happening with China. Now let's quickly talk about what happened in the market today, because again, it was a very volatile session. So we can see the Dow was down nearly 300 points, the S&P down around 1.26%, and the Nasdaq down 1.5%. So there is a lot of stress happening in the stock market right now, and it's all because of this, because the 10-year US Treasury, as we can see here, it pretty much did hit 5%, 4.997% on the 10-year US Treasury. And I don't know if you remember, but do you remember in 2020 and 2021, this phrase that a lot of stock gurus would say? They would say something called TINA, which stands for there is no alternative. Well, now there is an alternative for stocks. Now there is competition for stocks. Treasury yields are getting actually outperforming dividend stocks, and also their returns are getting close to the stock market. Yes, growth stocks over the long term may outperform, but if yields keep on rising, it's going to give more and more competition to the stock market. And also, like I say, a lot of retirees and a lot of hedge funds, a lot of 401k funds in Australia, superannuation funds, will be allocating more and more of their funds to bonds. and the stock market is still severely overvalued. But not just that, commodities. Look at this, gold is getting very, very close to 2,000. And I think if this geopolitical situation continues to get worse, and if we enter a severe financial crisis, initially gold will sell off, along with everything else as hedge funds and stuff get margin called. But once things really hit the fan, and see silver up good as well today, as well as Bitcoin. It's actually funny. Bitcoin's kind of looking like a safe haven. Even people on Wall Street are saying, is Bitcoin a safe haven now because it is rallying? But I think, no, it's not a safe haven. It's more because of the speculation of will a Bitcoin ETF get approved. But like I was saying, if we see a global conflict breakdown, if we see a severe recession, gold and silver, which has stood the test of time, if we see some fiat currency struggle, it will absolutely skyrocket violently. And if you're wanting to learn how to master the cycles of gold, silver, and Bitcoin as well, because we can see Bitcoin over the past few months has gone from nearly 16,000 to 30,000, so you can get the safe haven assets of gold and silver. Silver's more of a riskier asset than gold, but you can also get the upside with Bitcoin as well. And again, people, I think there will be violent moves. Next year is going to be the halving event for Bitcoin. I think we'll go on a violent rally. So if you're wanting to learn that, I have a 85% discount off. You can click the top link in the description. It's only $149. I see most YouTubers charge around $300 for their courses, but I wanted to give a more affordable option. And in this economy where everything's inflationary, give a deflationary price. But okay, what you're all here for, the regional banks that are facing big issues and the ones that are most at risk. So look at this, everyone. Regional bank shares slump as lenders warn of more pain from high interest rates. And I don't know if you remember, this was the kind of headlines we saw in February and March, right before we saw a few banks go under. Now again, why did those banks crash? It was because the bonds on their portfolio went down in value, and there was a lot of big institutional depositors, I guess you could say. There was some very rich depositors like at Silicon Valley Bank, some big corporations, some big tech companies that had deposits at the bank. They pulled their money out, and also people pulling their money out to put it in money market funds to get high interest on their money. While interest rates and bonds are even lower now than they were during the banking crisis in March. So what banks is it? Let's figure it out. Okay. So go ahead and adjust this here so you guys can read along, so it's a bit easier for you to read. So regional banks suffered a steep sell-off Friday after a number of weak quarterly earnings report is highlighting the negative impact from high interest rates and soured investor sentiment toward the industry. So the regional banking ETF fell 4%, dragged down by Regions Financial. So this is one to watch, which tanked more than 12%. Commercia, Bankshire Hills Bancorp, Merchant Bancorp, and Fifth Third Bancorp all tumbled by 5% or more. So this is Commercia, Regional Financials, Fifth Third Bancorp. That's something that I've had on my radar for a while, and these are some banks you may need to watch. And if you're banking with these banks, you might want to do a bit more due diligence and maybe spread your funds over some other banks, not just leave them all on these banks. Now, why are these banks falling, and why are investors so worried? So Regions Financial, a Birmingham, Alabama-based lender, posted a 6.5% decline in net interest income compared with the previous quarter. The bank also expects a further drop in NII. That means the interest they charge on loans versus the interest they have to pay to depositors is seeing a 5% decline in the fourth quarter. So what's simply happening is these regional banks, they're losing depositors, and depositors are putting their money in money market funds or treasuries. So what banks are having to do? Well, these regional banks are having to lift the interest they pay on deposits, And also, when they're trying to get some loans, be competitive in the loan business, they're having to drop their interest rates on their loans as well. So what this is causing is a huge contraction in their NII, their net interest income. Okay, for example, they may pay 4-5%, just for example, for people to deposit, and then a mortgage they may charge 7%. So we're going to see these banks come under sufficient, really significant profitability margin concerns. So Dallas-based Commercia issued a similar warning as Regions, saying its NII is expected to decline about 5% and 6% in the fourth quarter. The bank reported a $106 million year-over-year decline in its net interest income to $601 million in the third quarter. So that's a big drop, okay? Then their interest income is dropping by over $100 million, and this is big for some of these smaller banks. Also feeling the pain is this bank Fifth Third Bancorp, which is forecast a similar drawdown in the quarter ahead. Now, those are the banks that are facing big issues, but why it could get worse is because of this. I'll go ahead and adjust this here so you guys can read along. So bond market bad tidings starting to overwhelm the miracle stock rally. And this is exactly right. It has been a miracle stock rally. And you know the old saying, markets can remain irrational longer than you can remain solvent. And that's why you shouldn't try to time the market in the short term or invest for the short term, because this market rally has just been on all AI hype, okay? Yes, I think AI will change the world in the future, and a lot of companies will significantly benefit from it. But we see this time and time again with all new revolutionary technologies, like in the dot-com bubble. It always becomes significantly overvalued. Just because a technology will change the world like the internet, it doesn't mean you pay whatever price for it. And not every company will make it out of that boom. Also, the stock market's been rallying when interest rates are rising, when there's so much geopolitical risks, and when there's going to be a lot more competition for stocks from the bond market. So let's dive a bit deeper into this report to some key highlights to take out from all the fluff in this report. So resulting surge in nominal treasury yields has created a worthy competitor for risk assets. So profits in the S&P 500 are currently about 4.8% of the index's price, meaning that treasuries across the curve out-earn equities at the moment. That sent billions of dollars barreling toward bond funds all year, with investors eager to lock in lofty yields. And they say here, there's a point which there's an alternative to equities, and we're in that world now. Like I said, it's clear that if you're looking for yield, you're going to find it in a much safer place in US Treasuries. But again, this doesn't mean that the bond market sell-off is over. I think a lot of people are losing faith in the US creditworthiness, in their ability to repay over the long term. We're seeing long-term treasury yields are going up when short-term yields are going down. We're seeing the yield curve steepening. And at the same time, the Federal Reserve is still selling bonds, and a lot of foreign central banks like the Central Bank of Japan and China, which are the two biggest holders of US treasuries, will be selling as well to shore up their own currency. Now, listen to this. This is a very, very worrying time we're in right now, which is history repeating. So high inflationary episodes prior to 1991 provide a reasonable blueprint for today, according to Barclays. Should the current curve steepening episode follow that script, it would spell bad news for stocks as the Fed holds rates steady and long-end yields rise, pressuring cash flows and equity valuations. Especially a lot of these profitless tech companies, which has been booming over the past few years, when all of a sudden the cost of equity, which is what they need debt to grow because they're not profitable, and makes their stock valuation significantly lower, and also their earnings potential in the future lower. So also, bear steepening out of inversion seems to break from tradition in terms of a yield curve recession signals of recent past. However, looking further back to prior higher inflationary periods suggests that we have traveled this road before, which would leave equities few opportunities to escape unscathed. And that's exactly true. Another report we got here. I'll go ahead and adjust here. even strong earnings might not be able to save stocks, and again for the banks too. So what exactly is happening? Well, it's the volatility index, the CBOE volatility index, the VIX, which is also known as a fear gauge for the markets. So the CBOE volatility index, Wall Street's favorite gauge for fear and volatility, is hovering near its highest level in 6 months, and that has Emmanuel concerned. In Emmanuel's view, the VIX trading near 20 puts the index in a position to be micro-driven by things like AI and other investment themes, but at 21, a level that the index rose above Thursday, Emmanuel says market volatility becomes more driven by macro factors. Geopolitical risks include Ukraine, Russia, China, and now we can add the Middle East conflict between Israel and Hamas, is arguably as high as it has been at any time except 9/11 and since before the 1989 fall of the Berlin Wall. So everyone, are you starting to see the writing on the wall? I don't know how much more evidence, news, facts, and data I can show you to prove that there is big trouble coming. Like I showed you at the start of the video, China is injecting record amounts of cash in their banking system. All the indexes are in the red. People are flooding into safe havens like gold, silver, and also people speculating on Bitcoin. Regional banks are selling off again, okay? And unlike last time, bond market bad tidings are going to spell a lot of trouble for stocks. So I know what you're thinking, well, okay, how can we protect ourselves? Instead of just saying all this doom and gloom, what are some real solutions? Well, if you're in debt, don't even start thinking about investing in the markets. Also, if you don't have an emergency fund, get that first, because if you have lots of debt and you don't have an emergency fund, if things hit the fan and your portfolio tanks and then an unexpected expense comes up or you get laid off, you have to sell your assets at a loss. But if you have no debt, besides maybe a mortgage, okay, maybe a mortgage will be okay, and you have an emergency fund, if you lose your job during the recession or if an unexpected expense comes up, you won't be forced to sell your assets at a loss. And it'll give you a lot of peace of mind. You won't have to panic when there's a lot of volatility in the markets, okay? And how you can do that is there's no easy way around it, okay? When hard times come, I keep getting this phrase mixed up. Tough times don't last, but tough people do, okay? And when times get tough, the tough get going. There we go. I've got it. I nailed it this time. Okay? We're going to be in for hard times and we're going to be in drastic times that take drastic measures. You're going to have to start a side hustle. Now, what I did was I did YouTube. I love YouTube. I love speaking to you. I love speaking about things I'm passionate about. I'm passionate about markets, investing, economics. You may be passionate about fishing. You may be passionate about prepping. You may be passionate about camping, okay? You can do that as a side hustle. That's just one suggestion. But whatever skill you have, figure out a way to start as a side hustle, which one day you could make a business out of that could replace your income, because your job's income is not going to keep up with inflation. So you need to find something that costs very low capital, not a lot of risk, where you can go ahead, start your own business on the side. Don't listen to this advice like you see on YouTube, quit your job and follow your dream, when you don't even have a plan yet, or you don't even have a business that's profitable yet, okay? And if you can't do that, in the meantime, get a second job. And I go, saying, oh, this is going to be so much hard work. Well, yes, it will be hard work. But being broke, being in debt, living paycheck to paycheck, and being stressed about money every day is a lot harder, people. So this is what you have to do to get through these hard times. But if you do those things, you're going to see so much huge opportunities. You will see houses sold for pennies on the dollar when these interest rates finally flow into the economy, when unemployment rate goes up. You will see stocks sell for pennies on the dollar. You'll be able to pick up some bonds for cheap as well. Gold and silver is still a good opportunity. Bitcoin is still a good opportunity. If you do all these things, even though there's so much uncertainty right now, there will be big opportunities. So everyone, what do you all think about this? Thanks for watching. You're awesome. I'll see you all in the next video.